Form 5471 is an informational return from U.S. persons as it relates to certain foreign corporations. Those certain foreign corporations are called controlled foreign corporations, which means if more than 50% of the foreign entity is owned by U.S. persons, the IRS wants to know information on that corporation. It doesn't mean that you're going to have to pay taxes to the U.S. It doesn't necessarily mean. There are scenarios in which you may. It's simply an informational return. The IRS wants to know what your activity is with that foreign corporation because they don't have jurisdiction over it. And a foreign corporation can be a very effective tax planning tool. So the IRS wants to have that information on hand to make sure that they can do their own homework to see if you're abusing that structure. The type of information they're looking for the most part, is very basic. What you have to do is understand that there are different categories of filers. You're going to have to provide certain information if you're more than a 50% owner. You're going to have to provide a little bit more detail if you're entering into transactions with that foreign corporation. You're not going to have to provide as much detail if you're just an officer of that corporation or some other type of director. But the bottom line is the IRS wants to know about this foreign corporation. What do they want to know? They want to know ownership details, who the shareholders are. If they are U.S. persons, they want their names and social security numbers. They want to know as much information as they can on the foreign jurisdiction, meaning the foreign tax ID, the type of entity it is, where it was registered, when it was incorporated or created. This is all on the first page, very basic stuff. They want to know the financial statements, and now it gets a little bit more complicated, because you have to report your financial statements to the IRS on Form 5471 based on U.S. GAAP. If you're a company with inventory, if you're a company with technology and development, software that you're developing yourselves, then you're going to get into a very complex situation, because if the foreign jurisdiction in which you're operating does not follow IFRS, and we're in a period of time where IFRS is close enough to GAAP that it wouldn't be such a large effort to translate it. Unfortunately, if you're in a jurisdiction that has significantly different accounting principles, it's going to be a good amount of work for your CPA to translate those numbers so that you can report them on Form 5471, your balance sheet and your profit and loss. For most of the foreign corporations out there, this is the amount of information, and this is what you would need to be concerned to as it relates to the U.S. But let's understand how these transactions are taxed. Your foreign legal entity is a separate entity in itself. It's not subject to U.S. taxes, meaning you're not going to be taxed on any income, on any monies of that corporation until you actually perceive that income, whether it is you pay yourself dividends, you pay yourself wages, bonuses, etc. At that point, they will be taxed. But if there's $100,000 net profit of your corporation and they're not subject to Subpart F income, which I'll explain in a minute, those $100,000 are not going to be taxed to the U.S. They're going to be deferred, and they're going to continue to be deferred until you actually take that money out. Well, the IRS is going to want to know those details. They're going to want to know retained earnings and profits. They're going to want to know, well, what is the corporation paying on your behalf? Is there potential amounts that should be reported on your personal tax return? Are you lending the company money back and forth? These are all transactions that they want to know about it, because they can be abused. Because if someone knows how to bend the rules and look for the loopholes, they can essentially create tax-free income for themselves in the manner of tax deferral. A much more complex topic is Subpart F income. The Congress realized that there was this tool by which Americans living abroad, or even Americans, they could defer taxation on large amounts of money if they were in the net profit of a foreign corporation. Then Congress sat down and they said, well, there's particular types of income that we do not want to be deferred. As it relates to our audience, I think, this is called Subpart F income, by the way. As it relates to our audience, I think the most important one is consulting income. If you're a one-man show and you're generating $500,000 in net profit and you're only paying yourself wages of $60,000, you have Subpart F income, and you're not going to be able to defer those $500,000, defer the taxes on those $500,000. There are many other types of Subpart F income. The objective in this video is not to explain each and every one of them. There's going to be a link in the description of this video that is going to take you to an article that explains that in detail. But the objective, rather, of the video is to explain to you that while profit of a controlled foreign corporation is not taxable until you actually perceive that income, again, however you pay yourself out that money, it is important to realize that there are certain types of income on which deferral is not going to be permitted, and that's subpart F income.